Welcome, everyone, to Credit Chat Live. I'm Destiny White. Joining me today are Rod Griffin, Senior Director of Consumer Education and Advocacy at Experian, and our special guest, Jeff Richardson, who is the Senior Vice President of Marketing and Communications at VantageScore. And today we're just going to be diving into student loans and answering some frequently asked questions that borrowers may have. And I myself am a student loan borrower, and I have quite a few questions. And with that being said, I am so looking forward to this chat, and I'm so glad to be able to have both of you experts on with me to just unpack this topic. So thank you both for joining me. So I'm just going to get started with Jeff. Would you like to share a little bit about VantageScore?
Oh, sure. So VantageScore is one of the leading developers of consumer credit scores in the United States. We're owned equally by Experian, Equifax, and TransUnion, the three national credit reporting companies. And we have four credit score models out in the marketplace. The most widely used model is VantageScore 4.0. And we aim to develop credit score models that are more predictive and inclusive. So traditionally, a lot of credit scores left a lot of people on the outside looking in and considered them credit invisible. And so with innovative data and analysis, we're able to score those consumers and help them access mainstream financial services and credit much more easily than they could in the past. And, there was a time when there was a trade-off between being more inclusive and being more predictive. But with every new innovation and with computing power the way it is, and with the credit data as robust as it is, that's no longer the case. And so you can be both financially inclusive and predictive. There is no trade-off. So we've been in the marketplace since 2006, and we now have about 3,000 lenders using our scores. In 2022, we actually had 19 billion scores used in the marketplace. So grown tremendously, and I think it's a testament to the innovation that our data scientists put around our models. But glad to be here. Appreciate the invitation.
Yeah, thank you so much for that intro, Jeff. There's so many misconceptions surrounding paying off student loans, especially with the forbearance period ending. And I must share that lately I've heard quite a few silly comments from borrowers, such as, "Oh, those payments are out of sight, out of mind," like basically implying that they're just going to forget about those payments. I don't know if that's something that you've heard online, people talking about, or maybe even people that you know. With that being said, we definitely need to dive into this topic, dispel some of these myths, and educate our consumers a bit. So with that being said, Jeff, what are the different types of student loans and how exactly do they impact your credit scores?
Yeah, there's really two categories. There's student loans that are granted to borrowers and parents of students that are issued by the federal government. And that makes up the mass majority of the student loan marketplace. It's over $1 trillion credit category. And then to a smaller degree, there are private label student loans, or those loans issued by private lenders. And that's just a much smaller category. Now, within the federal loan category, there's a lot of different types. We've all heard them. I think, there's names like Pell grants and things like that. And they all differ slightly. But those are the two main categories. How do these things impact your score? So prior to the pandemic, certainly the existence of those loans would impact your score. The total balance of the loan would impact your score, and your payment history on that loan would impact your score. And we're going to get into what occurred during the pandemic in a second, but generally speaking, it's a little counterintuitive, but actually, student loans were benefiting a lot of people from a credit scoring standpoint. First of all, it was likely the first time a borrower got access to credit. So that would be the only account that would be reported to their file. So instead of having no information, they at least have one account and they're demonstrating the ability to make those payments, which is really good from a credit health and a credit scoring standpoint. And of course, the opposite is true. It is a loan obligation, and if you became late or if you ended up defaulting, those would have more negative impacts on your score. So a lot of things have changed since then, and we'll get to that. But generally, that's how student loans impact your score in the kind of the two categories.
So just kind of jumping in. So really, prior to the pandemic, Jeff, a student loan was very much like a standard installment loan in terms of impact, except that
That's
was
right.
tied to your education as opposed to buying a car. So it's kind of thought of the same way. If you're paying off that student loan debt and you're making those payments on time, it's going to help build your credit history, just like paying off a car loan, essentially. Um, differences and everything, but
And like I'll just double click on the fact that for many consumers, it was the first entree into credit. It was the on ramp to credit cards and auto loans, and served a very useful purpose beyond funding education, which is of course important into of itself.
the way they established a credit report for the first time, even though they
Correct.
often didn't realize that. You get the loan, you didn't think, at least when I was a student and I got a student loan, I never thought about my credit report when I signed
Exactly.
that loan agreement, that it was going to be reported. And that was probably the first thing that appeared in my credit history. So,
Yeah.
Yeah,
yeah.
me too. Me too. It's really funny. That's the reason I was able to get my very first credit card because I had an established history. I was very surprised when I put in my application and I had just turned 18 and I had just started college and I came to the conclusion that maybe a credit card would benefit me because I wanted to start building my credit history and it was very useful actually to have loans, but I was like, so I have 4 or 5 years until I need to start paying these off, or do I start paying them now? I guess that's another question that I wanted
That's
to
a
bring
unique thing.
to the
Yeah.
table. Yeah, because there's probably plenty of people who are like me who borrowed as soon as they started college and probably have not maybe made payments and just assumed that by the time they graduated, that's when they had to worry about student loans. So would you guys be able to clear up that misconception?
Yeah. I mean, so, that's a unique thing from a lender's perspective. I think it's the only kind of credit service or product where the lender is saying, yes, I'll loan you the money and I'll wait 4 years or 4.5 years before you start to repay me. So I'm taking on a risk that in 4 years or more, you're going to repay this debt, and I'm just going to hold it until then. It's not like that car where you get the car, you drive off the lot, and a month later there's a payment due. It's the lender's taking a big risk too, and I think the federal guaranteed student loans, same kind of issue. We're giving you a loan today that we're having confidence in you that you're going to start repaying us when you complete your education or when you leave school. So it's a bit, it's a hard one to figure out. That's why we have VantageScore and Jeff and helping lenders predict that risk.
The one caveat that I would add to that, and this maybe ties into kind of where we are today, is not unlike other loan categories, there are options when maybe you got out of college and you don't quite have a job. So there are like deferral programs and something called a forbearance, which we'll talk about here in a second. And so those types of abilities to kind of give yourself some cushion were already in place prior to the pandemic. So of course, not everybody gets a job right out of college and has the income to make those payments. So there was some wiggle room there. Of course, when the pandemic hit, what the federal government did was put all of those loans essentially in a forbearance status. And what that meant is that consumers would no longer have to make their payments and no longer be penalized for missing those payments. And they pretty much did this across the board for all federal student loans. And there were some impacts that did occur to scores because not everybody's credit profile is the same. And when you kind of do a blanket forbearance like that, it affects people in different ways. But by and large, the impact was that those loans were sort of put in a neutral state. So people's credit were it wasn't affecting people's credit to a large degree. And that allowed them to stop making payments, use that money for household goods and services or pay down debt. And we've been in that pattern ever since, and it was about 3 years. And of course, one of the reasons why we're speaking today is that that forbearance period has ended, and student loan borrowers are now required to make payments again.
Right. And I was one of those people who actually finished college right when the pandemic started. So that applies to me because this entire time frame from I believe it was early 2020 slash late 2019 when I had graduated, that is when they had put a freeze, a pause, as you said, on payments. And now I'm in the process of, making those payments. So that's it's very helpful when you're able to have that pause, but now it's time to start thinking about exactly how are you going to make those payments and what's possible for you. There's options for you if you are in a position where you're not employed, so that's a lot of things to consider. But Rod, I actually have a question for you. How exactly do student loans show up on your credit report? That's something that I've always wondered. How are they reported?
Yeah, student loans are unique in a lot of ways, including the way that they appear in a credit report for a lot of people because, well, let me rephrase that. They appear differently than people expect them to, because when you have student loans and you enter repayment, generally you write one check that covers all of your student loan debt. So you think of it as having one student loan, when in reality, while you were a student, each semester when you took a student loan, it was a student loan for that semester. So each year you could have two student loans, one for the fall semester, one for the spring semester. So you could have 8 student loans, and then you just paid the total balance. So in your credit report, you will likely see one student loan with a smaller balance for each of those loans. So you could see 8 student loans and be writing one check that pays for that total balance. So it can be surprising when people look at their credit report and go, wait a minute, I only have one student loan. I'm only writing one check. Why are there 8? Well, it's because you applied essentially and accepted one student loan each semester for a smaller amount. So, you caution people when you see that. Don't panic when you see that on your report. It just reflects exactly, precisely what happens in that process. And so the lender reports 8 small student loans instead of one big one. That's why I think it's important for people to understand when you look at your report, don't be surprised if you see multiple student loans, but they are all going to be for the amount you borrowed that semester, and they'll add up something close to what you're writing your check for the payment in the end. So, it's important to understand that when you see it, because it's different in that sense, and it can surprise you. So,
Thank you for the heads up, Rod. And Jeff, do you have anything else that you believe borrowers need to know about paying back their loans?
Yeah, well, I think it's actually a really good story for consumers. The first thing to know is that if and when you do resume payments, you're likely to see your credit score actually go up because we're getting more information, more positive information added to your file, and therefore your VantageScore credit score is gonna start moving up. So that's the good story. The other positive aspect of the plan that the Department of Education has put together is that if you're among those that are going to struggle to resume payments, you have a long on ramp to plan for that. So a delinquency to the Department of Education doesn't really occur until you're more than 90 days late. Okay. And so they're not going to report that 90 days late until around this time next year. So that gives consumers and borrowers a lot of time to balance the monthly obligations, save up. If they're not able to meet those obligations today, at least they can know that the delinquency isn't going to be reported to Experian or the other three credit bureaus and have what would be a pretty significant impact on their score. We did some analysis, and when the delinquency is reported, which again will be late 2024, it will have a negative impact on consumers who are reported in such a way. And it could be, depending upon your credit profile, as much as 80 points, which is sort of similar the similar impact that you get if you missed another installment loan like an auto loan. So it's a very important date to sort of think about this time next year. For those that can, we really encourage go ahead and start making your payments like you have, Destiny, and likely to see some improvement in your score. But if you can't, at least know that the information isn't going to be reported for quite some time. The other thing that I would just maybe also touch on that kind of speaks to the mechanics of how the student lending market works is, while the federal government is the guarantor, they work with what's called loan servicers. And so these loan servicing companies are actually the companies that you'll deal with. They'll send you the bills. You'll be making payments to them. And so they're responsible for sort of what we call servicing that loan or managing your payments. And then also they'll be responsible for reporting that information in an accurate way back to the credit bureaus. And there's been a lot of changes in the servicing industry as well. So the loan servicer that you had before might not be the same loan servicer that you have now. You might have canceled the bank account that you had like on auto pay for your student loan prior to the pandemic, and you may have a different bank account now. So there are these sort of mechanical things that you have to, from a student loan borrower standpoint, take action on, understand, and there are resources out there, including your loan servicer. That is a great place to start to ask questions. I know that the Experian credit education team has a ton of information on Experian's website, and certainly we've invested heavily in providing some educational content for student loan borrowers as well. What we did is, in addition to kind of crunching the numbers and giving people an idea of how their score could be impacted, we worked with the former Department of Education leader and developed a pretty comprehensive FAQ. It's about 40 questions and really tackles every consumer question we could think of that consumers might have. Everything from like, how and when do I make payments, to whom, what other payment plans are out there, and links to all of these new programs that Department of Education has launched. So what made a lot of headlines, right, over the summer is that the administration's student loan debt relief program, where they were going to relieve quite amount of student debt, actually didn't happen. It was taken to the Supreme Court, and the Supreme Court ruled that it didn't have the jurisdiction under the law to forgive that much student loan debt. And so instead, what you're seeing is the iceberg being chipped away. And so there's been sort of smaller scale student loan forgiveness programs. People who work for state and local governments could potentially qualify. Those who have been paying their student loans off for considerable amounts of time could qualify. And so there's a lot of these different programs out there, and we've we've taken the time to identify them. It's kind of an alphabet soup of acronyms. So I'm not going to go through all of the programs like the SAVE program and all this and that and the other, but they are on
Right.
this section of our website. And the links will take you right to where you would need to go to find information from Department of Education and actually apply to be part of those programs. The last item on that front that I'll mention, maybe two more. You guys got me going. Um, uh, so if you do
Yeah.
qualify for student loan debt relief, what is supposed to happen is your loan servicer, the student loan servicer, the company we were just describing, actually is to get in touch with you and say, okay, you've had your loan forgiven. So you'll be getting notices in the mail. If you believe you do qualify and you didn't get one of those notices, by all means, look into it, contact your servicer, and look into it. There's another program that's been rolled out that's called Fresh Start. So what Fresh Start is for all student loan borrowers that were actually previously in default. In other words, they were already 90 days past due. They are getting a fresh start. So what's essentially happening, and Rod, please fill in the gaps if you see them. The previous loan is almost going to be reissued, and you'll be where you were once 90 days past due. You will be current, and you'll enter into a new payment plan, and you'll resume payments.
Wow.
So that's an important program for all consumers who were really struggling to make payments heading into the forbearance periods that started once the pandemic started. And there's a lot of options within the Fresh Start program to get those borrowers back on track.
And I think there's one of the things to understand about the forbearance process during the pandemic was that when those federally guaranteed student loans went into forbearance, they didn't. If your account was current, it remained current. So you didn't have to make any of those payments. When the forbearance period ended, they would continue as current. If your payments were already late, then whether it's 30 days, 60 days, 90 days, and as Jeff said, it's probably 90 days because that's when they would report. Then when the forbearance ended, it picked up at 90 days late. The accounts didn't become more late, but they start up right where they left off. And that's where the Fresh Start program comes in, is helping people with that issue. So there's an option there if you qualify to kind of help reset that and bring you back to kind of start again, to get a fresh start. So there are a lot of options with federal guaranteed student loans, not as many with private loans,
Right.
although they tend to kind of, I think, follow suit to some extent. But I used all of them when I had student loans. And that was a long time ago. So personal experience on forbearance and deferment and hardship deferment and consolidation and you name it. I did all of it. So
And there's
able
also
to get them paid after 15 years.
There's
Go ahead, Jeff.
also
I'm sorry.
Yeah, I was just going to mention the Department of Education's also introduced kind of new income-driven repayment plans. So they've made it easier to kind of connect the type of payment that might be easier to make with the level of income that a borrower or a family is bringing in. So that's another area that if a borrower is worried, is struggling, certainly look into that. Again, we know we've got some of those programs identified on our website, and Department of Education has a lot of resources around that as well.
I'd add there too, anytime you're entering into an agreement, make sure that you understand the terms. So if it's an income-based repayment plan, does that lower your payments? Does that mean that interest will continue to accrue? And so will your payments cover interest and additional principal, so your balance will go down? Will making reduced payments cause the loan period to extend. So it'll take longer to repay, but it makes your payments more manageable. Make sure you understand what the agreement is and what you're agreeing to, because that's going to be important, just so that you are making a decision that's best for you. So, but like Jeff said, talk to your loan servicer early and work with them, because they do have tools that are available now that weren't before.
You've got this kind of grace period, and they make a few payments throughout that grace period. Kind of what will their status
Whatever they
be
can
if
do.
they've subsequently missed some
Right.
payments? I do think
Right.
it would probably, depending upon when they made those payments, be considered delinquent if it was more than 3 months since the last payment. Um,
Mm-hmm.
but I think to your point, though, you can get current. If you've been 30 days, if you've been 60 days, the advice we would give is that prior to that 90-day threshold, start to make payments, even if you've been 6 months since your last payment, because again, if you can kind of start getting those payments going in succession before that time frame in 2024, and it's probably going to be closer to actually November when those payments are reported. Um, the you should be reported current, but again, you'll need to pay close attention to what your loan servicer sends you and tells you. You want to monitor your credit report on an ongoing basis, and monitor your credit score on an ongoing basis. I think where I thought you were going, Destiny, is kind of like the best thing to do is just to be engaged, right? Like, don't let things happen to you. Like, be proactive and understand your options, even if it's just talking to the servicer. I mean, they have a strong incentive to make sure that you as a borrower are able to make payments or understand how to adjust your payment plans and schedule and obligations. And so open up that dialogue, research these plans, and don't just sort of like go on autopilot for the next 12 months.
I like that advice. Stay engaged. Make sure you're asking questions to your loan servicer, and you're basically reassuring everyone listening that you have time to play catch up. Essentially,
Yeah.
you have grace, you have a cushion, and you have to make sure you're diligent in communication and being engaged with making those payments, because they can positively impact your credit history. They can benefit you making those payments. So, thank you, thank you. I don't know if you had any other comments to add,
Yeah,
Jeff
I
or
was just going
Rod.
to say another way to think about the payments and whether or not they're delinquent is when you talk about the payments that are, you have a certain number of payments you have to make uh, to complete that loan agreement, right? So if you are 30 days late, you missed one of those payments. If you're 60 days late, you've missed two in a row. If you're 90 days late, you've missed three in a row. And so the challenge is, if you miss three payments in a row, you're missing three payments. So you're 90 days late. Now you make a payment on the fourth month. You're still 90 days late. You still have three payments you didn't make.
Mm.
And so you need to catch up on those payments, because over the course of that loan, if you have, for simple math for me, if you have a loan that's a year, it's 12 months. So you need to make 12 payments in that time if it's due. So if you miss three, you're still 90 days late. So in order to catch up, you have to make that fourth payment plus three more in order to be current again. And so that's the challenge. So you
Wow.
would still be 90 days late if along the way you make a payment and then you miss another payment. Now you have four payments that are late that you didn't make. And so, it becomes further delinquent. And so
Wow.
that's the kind of the way to think about it. So it's better to not fall behind in the first place, because it's harder to
Right.
catch up once you fall behind.
The the
Thank
one
you for
So
ad
kind of
clarifying.
think of
that
it that way. Yep.
the one add to that would be with this grace period, um, you won't be expected to make kind of like 12 months of payments, this time next year. You'll be expected to catch up on probably the last three. Don't think like you need to save up a year of payments, like a big balloon payment. It won't be like that.
Right. Yeah, and student loans are not that way, but just generally thinking about debts, and
Yeah.
student loans being like installment loans, it's think about how many payments you need to make to fulfill the terms, and that's 30 days late means you didn't make a payment for that payment period. So
Right.
it's and again, eventually it's going to roll back around, and with the student loan, you need to make those payments on time every time if you can, because that's what shows lenders that you're a reliable borrower, and that's what will be reflected in scores. And that's that time that's so important. It's the way you manage your credit over time is what really drives credit scores. And so consistency is key. Other than our PR team at Experian hates it when I say this, but lenders, boring and dull and consistent and having absolutely no spontaneity is incredibly sexy to lenders. They don't like surprises. So be consistent and dull, make those payments on time, and even student loans are going to help improve your credit.
Yeah,
But it's just being consistent over and over and over again. So
that's good.
that's still going to apply at some point in the future. There's programs that can help you get a handle on the student loan debt and control it so that you can do that. So take advantage of them.
Yeah, that's really good advice from both of you. So thank you both so much for just going into detail and giving our listeners a clear picture of what it's going to look like making those payments on time, how they're, going to affect how it would affect, their process of paying back the loans and just things that they should keep in mind. That's awesome. And I do have a question that either of you could answer. So, what are some best practices, like with all that being said, best practices for managing your credit scores, managing your credit while you're paying off your student loans?
So
But
I just mentioned the importance of monitoring your credit report and score. Um, I'll also just tack on to that. Uh, don't apply for credit you don't need, particularly if you're going to take advantage of this grace period. Understand that that's not just uh, you know a, 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 a grace period that's going to last forever. Understand, like, if you do apply for credit, that has the potential to put you into what we call a debt spiral, because all of a sudden now, instead of just having your student loan due, you've got a personal loan due or a credit card loan due. So really be careful and mindful about applying for additional credit, as you're starting to make these payments, or be expected to make these payments on your student loan. Um, Take advantage of auto pay. I think it's really easy to get busy. I know we're all busy. We've got kids that need to be shuttled around, and some people don't even look what's in their mailbox anymore. So being able to put payments on auto pay is really beneficial. And sometimes the loan servicers or the lenders actually provide you some incentive to do it. Sometimes the terms are a little bit better if you'll do that. Um, there's also the opportunity, if you are if you've got a lot of different loans, and you're making, it's just too many payments to make, you can get a consolidation loan, and consolidate those into a payment, particularly if you've got a lot of outstanding debt where the interest rates are really high, and we know that rates have increased significantly over the past 12 months. Sometimes a debt consolidation loan could be a good option, so that you're only making one payment, perhaps at a lower interest rate. Again, the same caveat I would mention is if you do that, understand, yeah, you may have moved the balance of your credit card over to this debt consolidation, and it may be tempting to go out and use that credit card, but be disciplined and don't put yourself in a worse position as a result of consolidating that debt. Um, and I guess maybe I'd just reinforce, just take action. Don't let things happen to you. There are a lot of plans out there to take advantage of, and this is could be also sort of a changing situation. I think the administration and a lot of politicians really are focused on this issue, and there's a lot of ideas still being discussed to try to provide additional programs or benefits. So pay attention to what's being rolled out, and don't feel like you can't ask questions. Those loan servicers, that's their job.
Yep, absolutely. And I'll just kind of reiterate a couple of things and maybe another couple of suggestions. So when it comes to managing a report, Jeff's exactly right. You have to make those payments on time. Use those tools that are available to you. Um, Enroll in a free monitoring service. Experian has them, of course. You can go to Experian.com and monitor your credit report. You can get your credit report once a week at annualcreditreport.com from each of the bureaus. And I'm not sure you need to check it quite that often, but you can. Your reports typically are updated by your lenders once a month for each account, so it can happen throughout the month. Things can change, but you can check it as often as you like, and know that checking your own report will not affect your credit scores, it won't affect lending decisions, so don't be afraid to do that. The other thing to think about is if you're working to improve your credit scores, or adding information that will help you along the way manage them. Things like Experian has a new service called the Experian Smart Money digital checking account and debit card. So if talking about automating your payments, you can make payments to the checking account. It embeds our Boost program or Boost service that lets you have your positive cell phone payments, your positive utility payments, your positive streaming service payments, even potentially your rent, if you're paying your rent through one of about 1,500 property management companies that we work with, or an online service that we're working with. You can add your positive rent payments to your report. That can help improve your scores as well. And typically that's not reported. VantageScore it recognizes those payments and is really innovative in looking at what we think of as additional FCRA data, or new FCRA data, FCRA being the Fair Credit Reporting Act, so it can be part of a credit report. And those tools now are available to help empower you to kind of overcome some of those barriers to financial inclusion, to help you manage the debt you have, to be able to qualify for better credit tools and resources at lower rates. So, when you're thinking about your student loans, take advantage of the programs that are there. Take advantage of the new tools and resources that are in the marketplace that weren't just a few years ago to help you stay on top of it. Don't be afraid to get your credit report. You know what's in it, and then you can do
Yes.
something about it. And until then, it just seems mysterious, and it shouldn't. So, pretty simple to say, kind of hard to do sometimes. Make those payments on time every single time.
Yeah, that's really good. And I liked how Jeff said, he threw out the auto pay feature. It's really,
Yeah.
really useful. Highly recommend. And yeah, definitely just staying on top of your credit report. Knowledge is power. And also, not opening up too many credit cards, not having to worry about so many different payments. It could be very overwhelming. You might not be able to financially keep up with that. And you don't want one missed payment or one super high payment to impact other payments, and you have missed payments on your report and then your score goes down. There's just so many things to keep in mind on a monthly basis, especially when you're a student loan borrower and things just feel like they're catching up to you and getting overwhelming. So I just wanted to thank you both for those spectacular tips. And with that being said, I do have a quick question. What should someone do if they've previously defaulted on a student loan? I know we kind of already touched on this, but what would be like the first step when they realize, oh no, I have a missed payment on my credit report?
Yeah, I think the first step would be to Google Fresh Start Department of Education, and more than likely, what will come up is a link to how you can apply for the Fresh Start program, learn more about it, and take action. Because, in particular, it's those borrowers that the program is designed for, and indeed, you can get a fresh start. So take advantage of that.
Wonderful. Wonderful. So I think I have one final question. What other advice could you share with college students who are going to graduate with student loan debt?
Yeah, I understand that it's not free money. This was a loan, and it can and will be reported to the credit bureau. So um, make that information work for you, and not against you. Um, the 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 other piece of advice is like, yeah, you probably, for some of us, we didn't get jobs right out of college. And so there are programs that will kind of give you some leeway in terms of when you have to make that first payment, or when those payments start for you. Um, and I guess the other thing is uh, you know, a lot of times, there's a temptation to after you get your first job, you get your credit card, you get your fancy car, and all of a sudden 6 months later,
Oh,
you're
yeah.
you're 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 underwater, you're feeling the pressure. Try to resist those temptations. Talk to credit counselors if you need to. They're oftentimes free. If they are charging you, you're talking to the wrong person. Talk to the people that do it for free. Don't pay for credit counseling advice. Oftentimes, those are credit repair companies that don't have your best interest in mind. Um, and
Correct.
take it slow. I think you've got a loan that's being reported. You're probably not going to be in the position to automatically apply for a mortgage loan. So slow and steady wins the race, and in no time you will be ready to make an application for a home loan if that's something you want to do, and save up money for that down payment. So for all of us, that was a process, and it took some level of discipline, and it's a wonderful thing to find yourself in a position where you've got a healthy credit report, healthy credit score, and you don't feel like you need to go to sort of what I call lenders of last resort. You want to be the power, take control of your finances. Experian Boost is a terrific product because it really puts the power back into the consumer's hands. Just be empowered, and be educated, and take it a little slower than maybe you thought you might.
Yeah, times it seems like things are going so fast, but you have time when you're young. Take it from somebody who's not as young as I once was. But I would add too, if you are not graduating yet and you're thinking about taking student loans on, or you need to, be aware that you don't necessarily have to accept every penny that's offered to you. So think about how much student loan you need to take on. And if you're offered a loan for more than you need, perhaps you say, I don't want all of it, so that you reduce your debt before you
Right.
take it on. And I didn't know that. The bank gave me, said, here's your loan for the semester. I went, yay, and took every penny. And then I got out of college and I went, oh, shoot, wish I had known then. But,
Isn't that
you know,
right?
it comes at you, but take your time. And Jeff apparently knows me and is reading my life story because I bought that car. It was awesome. Loved Chrysler Sebring. It was awesome, and way too expensive for the start of my career. So think about where your expenses are. You think of a student loan. One of the ways that I've kind of started describing it into my kids is, think of a student loan as sort of two parts, or it's an investment in your education. So think about a student loan in terms of repaying it like a car loan. The average student loan today is something like $27,000 or $30,000. The median's like $36,000. That's just about the average new car loan amount. And so, people never tell me that they're frustrated they can't pay off their car loan because it's too much when it's 5 years. But your student loan is like a mortgage in terms of an investment in your future and your career. If you have a degree, all of the studies show that you'll likely earn as much as $1 million more over the course of your career. So think of it like a
Oh, yeah.
mortgage investment in terms of what it's going to do for you, but think of it in terms of repayment like a car loan, and weigh what you need. Maybe you don't need that fancy new car. You get a less expensive used car, and treat that student loan as the priority, and it'll go away faster than you think, and then free up so that you can have that higher end car later, which would have been a better choice for me, but it worked out. So, and now I drive a Hyundai. So what are you gonna do? So in a Honda. So I learned over time, but
Right.
it's think of that student loan as an investment in your future. It seems like a lot, and it seems like it's going to take forever, but if you look at the payment amount as it relates to what people are paying for new cars now, for most people, not everyone, and you have to acknowledge that it's a crisis. There are young people with enormous student loans. For the average borrower, it's somewhere like a new car loan in terms of the amount they
Agreed.
owe. So kind of approach it maybe as a way to help with the way you think about it, and repaying that debt.
Yeah, I definitely would see, borrowing and borrowing and having student loans as an investment in yourself. And also, it's very important, on another note, for listeners as we wrap up, to understand that credit is a very useful financial tool, and having student loans is credit, and it does not have to be daunting. And it is a tool to give you important resources that you'll need in your future. As Rod said, you could think of it as a what did you say, a
Like a
vehicle loan.
Yeah, so think of it as, the payments, if your student loans are like the average car payment of a car loan
Car
amount today,
payment or loan.
think about repaying it like you would the car loan. So to kind of treat it that way. But
Right.
then, also think of the difference between a car loan, which is, it's a product that depreciates and goes away, and you'll get a new one at some point.
Mhm.
Your education never goes away, and will be
Exactly.
there to work for you. So it's more like buying a house. It's 30-year
Buying a house.
investment, but your education is that lifetime investment. For a lot
Right.
of
And
people, it seems like a burden, but when you compare it to new car loan amounts today, the average new car loan is something like $40,000, somewhere in that range, and the new car payments are like $700 a month, and most people's student loan payments aren't that much anymore. So,
no.
so it's seems like a huge burden, but if you kind of prioritize, it might be able to help you. So just trying to, I play mind games with myself all the time to make things easier to approach, right? And what's the plan? So that, that's what I tell my kids too. Think of it as a long-term investment, but treat it like a short-term or shorter-term loan.
Right. And if you're listening, please, I hope this encourages you to look into what your loan payment is and to make sure that you're on time, you're current, because credit's really important. It will unlock possibly a future, a vehicle with a good interest rate, a home with a good interest rate. Just it will unlock so many doors for you to have good credit and to be on top of things. So that's why this conversation is very crucial for maybe those who might be in the dark about student loans and might have misconceptions surrounding paying back their loan. So I really hope this was helpful for anybody listening. And as we wrap up, I just want to say thank you both so much for your really crucial insights today. And I'm sure this chat's going to help so many borrowers out there, especially those who are making payments for the first time. If either of you had any closing remarks or a final tip before we end the conversation.
I always learn, and Yeah, always love to have conversations with Jeff and what's happening with VantageScore because it's an incredibly innovative company, and it's always been focused on the consumer as well and making it easier to understand. So, credit scores can be very confusing. VantageScore will help you um, as an individual better understand what goes into a score, how it works, and they've always been focused on that kind of aspect. Helping businesses make better decisions, but also helping people better understand how the process works and how to use it to their advantage.
I just really appreciate those comments, Rod, and appreciate the opportunity to share with you guys some insights and happy to come back and if there are folks who want a little bit more information, go to VantageScore.com and there's a consumer tab and there's a ton of student loan information as well as tips for other loan types as well.